Hey guys, what's up? Welcome back to another video. In this video, I'm going to be talking about a stock that recently announced earnings for the second quarter of 2023, and that stock is Meta Platforms. And as we can see, over the last year, Meta is up 102%, completely dominating the rest of the market's 13% return. So they're doing really well this year, obviously recovering from their lows of around $88 per share in November 2022. Now they're back up to $325. So in this video, I'm going to look into some of the recent news that came out surrounding Meta, and there is some pretty exciting news about the company. I'm going to look at the financial statements, and then lastly, I'm going to use a discounted cash flow model to figure out the intrinsic value per share of Meta by using the weighted average cost of capital for their company. So right here, we can see this article is titled Meta Stock Surges After Earnings as Year of Efficiency Pays Off. One key point I want to touch on right here is that Meta beat their top and bottom lines for the second quarter and gave rosy guidance for the current period. So they're doing quite well over the last quarter. Right here, they point out revenue jumped 11% year over year to $32 billion, surpassing analysts' estimates of $31.12 billion. For the third quarter, Facebook, parent company, forecasted revenue of $32 billion to $34.5 billion, which is above the expected $31.3 billion of revenue for their third quarter. The results are basically reflecting a rebound in online advertising in the tech industry, as well as signs that Meta's year of efficiency is paying off and that their cost-cutting measures and their mass layoffs are improving profitability. Right here, we can see that Bank of America increased their price target on Meta's shares to $375 a share, where before it was at $350, and they reiterated their buy rating on the stock. And then lastly, although there's a lot of good news surrounding Meta, there's still uncertainty surrounding their investments in the metaverse because they signaled growing losses in their company's Reality Labs unit on their income statement. They had $3.7 billion of operating losses for their Reality Labs segment, which includes their investments in the metaverse. And Zuckerberg also said that he expects these losses to increase meaningfully in 2024. So the losses aren't done yet for investments in the metaverse. They're still in the trenches trying to build that thing out. But all in all, we can see there's also a lot of positive news for Meta, particularly with Facebook and their rebound in advertisement revenue. Then right here, something interesting happened. Meta, Microsoft, and Amazon team up on a Maps project to crack the Apple-Google duopoly with Apple Maps and Google Maps. We can see right here some key points include the fact that the group formed by Meta, Microsoft, and AWS and TomTom is releasing data that could enable companies to build maps that rival products from Google and Apple. The data notably includes 59 million points of interest, such as restaurants, landmarks, and other collected data, and it was donated by Meta and Microsoft. Right here, they point out that they're basically just trying to offer another option for app developers and consumers who want to use a mapping service. Right here, the group that was formed by Meta, AWS, Microsoft, and TomTom is trying to release data that would enable companies to build their own maps without having to rely on Google or Apple. The Overture Maps Foundation, which was established late last year, captured 59 million points of interest for their map product, and the data has been cleaned and formatted so it can be used as a free base layer for a new map application. For a lot of companies, Google and Apple's maps aren't ideal because they don't provide access to the underlying data. Instead, those companies allow app makers to use their maps as a service and in many cases charge each time the underlying map is accessed. So for example, Google Maps forces their app makers to pay per 1,000 Google Map lookups through an API, application programming interface, and Apple allows access to Apple Maps for free native app developers, but web app developers need to pay. Overture, on the other hand, is only offering the underlying map data and leaving it up to the companies to build their own software on top of it, sort of like open source. And then lastly, right here, they point out that digital maps are important for nearly all mobile apps. Emerging technologies like augmented reality and self-driving cars require high-quality mapping software to work. Overture's data could allow companies to integrate their proprietary information using exact pickup locations for a delivery app to customize their offerings. So basically, they're trying to offer a more advanced map option that's better than Google and Apple Maps. Obviously, it's going to be very difficult to replace Google Maps and Apple Maps because those products are used by so many people, but this is a new entrant and it does offer some competition to the Apple-Google duopoly. Then right here, these are their financial statements. We can see their income statement here. Revenue increased year over year by about 11% from $28.8 billion to about $32 billion for the second quarter. And we can see net income increased from $6.6 billion to $7.7 billion, up 16% year over year. We can see their balance sheet right here. Total assets are up from $185 billion to $206 billion. And then we can see most of their business is financed by equity compared to liabilities. They have $134 billion of equity and $72 billion of liabilities. And their retained earnings increased from $64 billion to $67 billion over the last period. And then lastly, right here, we can see their cash flow statement. Operating cash flow increased from $12.1 billion to $17.3 billion. And for their financing activities, we can see they repurchased about $900 million of Class A common stock in the second quarter of 2023, compared to about $5.2 billion of repurchased common stock in the second quarter of 2022. So we can see in this quarter, they're mainly prioritizing increasing the amount of capital they have through long-term debt, probably using that cash to invest into the metaverse, but they're not really prioritizing returning value back to shareholders this year as much as they were last year. Right here, this is my discounted cash flow model to figure out the intrinsic value per share for Meta. We can see right here, I'm using a projected growth rate of 4% for the next 5 years and 2% for the next 5 years after that. I derived this growth rate by using this growth rate calculation here. Meta's free cash flow for 2018 was about $15.3 billion, and their free cash flow for 2022 was $19 billion. That's growth over a 5-year period, which comes out to a compounded annual growth rate of 4.39% year over year for the last 5 years. So I'm going to extrapolate that into the next 5 years and use that for this estimation. Right here, for the weighted average cost of capital that I used to calculate the discount rate to discount the free cash flows to the present value, we can see it's 8.85%. I got that from this formula right here. First, I calculated the cost of equity by taking the risk-free return, which is a 10-year treasury yield. I added that to Meta's beta, which is 1.21, multiplied that by the average market return, 10% minus the risk-free return, and that gave me their cost of equity, 11.28%. We can see their cost of debt right here is 1.85%. Equity proportion, as we saw on their balance sheet, most of their business is made up of equity compared to liabilities. They have around 75% equity, 24% debt, and that means that their weighted average cost of capital came out to 8.85%. I basically just multiplied their equity proportion by their cost of equity, added that to their debt proportion multiplied by their cost of debt, and then multiplied the debt proportion by the tax shield, which is just 1 minus the tax rate, and that gave me the weighted average cost of capital of 8.85% to use for the discount rate for this discounted cash flow model. We can see that free cash flow right here, starting from their most recent full year, which is 2022, was $19.04 billion. Their net cash minus net debt comes out to around $9.18 billion, and they currently have a little over 2 billion shares outstanding. That puts their intrinsic value per share at $117 per share, which means that at the current share price, they're definitely trading above intrinsic value per share based on these estimates that I'm using in this discounted cash flow model. But that being said, we can see they did return quite a bit over the last year, and they do have increasing earnings estimates for the future. So I definitely encourage everybody to do your own due diligence when using a model like this, because a discounted cash flow model obviously uses a lot of assumptions, mainly growth rate and weighted average cost of capital. Right here, I did a competitor analysis, industry analysis, comparing them to some of their other competitors. Google, because they obviously offer a competitive advertisement service, and then Microsoft, because as we saw from the article, these companies are sort of all intertwined with each other, big tech companies competing against one another. For gross profit margin, we can see Meta has the highest at around 80% compared to Google's 55% and Microsoft's 68%, but they have the lowest net profit margin at around 19% compared to 21 and 34 for Microsoft. They also have the highest price to earnings ratio compared to their competitors, and they don't pay a dividend. So based on this industry analysis, it looks like if you wanted to give it to the company that has the highest gross profit margin, it'd be Meta, but in all the other areas, it'd probably be between Google or Microsoft. And lastly, I wanted to compare Meta to some of the other companies we've looked at in past videos. In terms of intrinsic value to share price, we can see that Meta comes in last place. They had a share price at the moment of $325 per share, and they had an estimated intrinsic value per share of $117 per share. It means that right now their share price is trading at around 2.78 times their intrinsic value per share, which is not really good enough to get them competitive on this table. Right now, Google, Alibaba, GE, and Etsy are the only companies we've looked at that are trading below intrinsic value. In terms of growth rate, we can see Meta had a projected 4.39% growth rate. Definitely not good enough to get them onto or make them as competitive as the other growth rate estimates on the table. And we can see right here for companies ranked by dividend yield, Meta doesn't pay a dividend, so they don't really make it onto the table necessarily. These are just the companies we've looked at so far since adding the dividend yield table. But as we move on, obviously this table will change with companies that actually do pay a dividend. For gross profitability, we can see that Meta had a 78 or 79% gross profit margin, puts them in second place, right behind Adobe's 86%. And then for net profit margin, they come in last place with a 19.9% net profit margin. Microsoft comes in number one with 36%. And then right here for the second quarter year-over-year revenue growth, Meta comes in fourth place compared to the other companies we've looked at so far for the second quarter. They had an 11% year-over-year revenue growth. Tesla had the number one spot with 47%. And then for year-over-year earnings growth for the second quarter, we can see that Meta has a 16% increase in earnings growth year-over-year. Kura Sushi had the number one spot with 240% increase in Q2 earnings growth year-over-year. Then lastly, for companies ranked based on stock performance, Meta doesn't make it onto the 5-year chart here. We can see that over the last 5 years, they're only up 54%, even though they're up from their lows of around $88 to $90 per share. They've increased a lot over the last year, over 100%, but over the last 5 years, only by 55%, so that's not good enough to get them onto this chart. Right now, Tesla holds the number one spot with their 1,144% return. So based on this, it looks like Meta is fairly competitive. They show up on every single table: earnings growth, revenue growth, profitability, growth rate. But for a lot of the tables, they're sitting at the bottom. The only tables where they're really sitting at the top are gross profitability and year-over-year Q2 earnings growth. For the industry analysis, we can see that they're not really dominating. They have the highest gross profit margin, but right now their investments in the metaverse are really eating into their bottom line net income. And then lastly, for the discounted cash flow model, we were able to see that based on their weighted average cost of capital, that they're currently not trading below intrinsic value per share based on these growth rate estimates. So let me know in the comment section down below what you guys think of Meta Platforms. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.